All right, let's dive into Standex International, ticker SXI, because this one is a real head-scratcher. They just reported a fantastic quarter, beat on everything, and even raised their guidance for the future. So what did the stock do? It dropped, and that's the puzzle we're going to solve today on Talk Tickers. I mean, look at this. On one side, you have everything you'd want to see. A strong beat, a guidance raise, total win. And on the other side, the stock price actually faded by over 2%. It just doesn't seem to add up, right? So to figure out what the market was thinking, we first have to appreciate just how good these results really were.
So let's get right into the numbers. And when you look at them, you'll see why that stock drop was so surprising. This was a clear, unambiguous beat on all the key metrics that investors watch.
First up, earnings per share. The company delivered $1.99 on an adjusted basis. Now, Wall Street was expecting something in the low 190s, so that is a really solid beat. A great start.
Revenue also came in ahead of expectations at $217.4 million. But you know, the real story here is the growth. That number is up a whopping 27.6% from last year. That is some serious momentum.
And this might be the most important number of the whole report. The company booked a record $226 million in new orders. That is the highest number they have ever posted in a single quarter. It tells you that demand isn't just strong today, it's actually getting stronger.
Okay, so let's pop the hood and see how the engine's really running. And spoiler, it is humming. Operating margins expanded nicely, which means they're getting more profitable. Their key electronics business has a book-to-bill over 1, meaning they're getting more orders than they can fill right now, and their debt is coming down. These are all the signs of a really healthy, well-managed company. So the numbers are telling a great story. But you know, numbers are only half of it. What about the people running the show? What did management have to say? Well, their story was just as bullish, maybe even more so.
I mean, listen to the CEO, David Dinar. He comes right out of the gate with this. He's basically saying, that plan we gave you, we're already ahead of schedule. That is the kind of confidence you love to hear from a CEO.
And here's where they put their money where their mouth is. They didn't just talk the talk. They officially raised their sales guidance for the full year. Folks, a guidance raise is one of the strongest signals a management team can send. It's them telling you, this isn't a fluke. The good times are going to keep rolling.
Now, you might be asking, where is all this growth and confidence coming from? Well, it's not happening by accident. It's actually part of a much bigger, really smart strategic pivot the company is making. They are diving headfirst into the massive trend of electrification. And you can see it right here in their sales mix. This is not your grandfather's old-school industrial company anymore. A full 30% of their business now comes from these super high-growth areas, like upgrading the electrical grid, building out data centers, and even space tech. They are successfully shifting their entire business toward the future.
And this transformation is all part of a very deliberate game plan. Step 1, they bought the right companies to get the technology. Step 2, they rebranded to make their focus crystal clear. And Step 3, they're expanding their factories in places like Croatia and Mexico to meet all this new demand. It's a clear, focused plan, and it's working. And while they're growing, they're also getting smarter and leaner. They're closing 4 older sites to streamline everything. Now, that's going to cost a little money up front, but it's set to save them about $5 million a year down the road. It's that classic short-term pain for long-term gain.
Okay, so let's recap. We have great results, a raised guidance from a confident management team, and a compelling strategy for the future. Which brings us right back to the million-dollar question. Why on earth did the stock fall after all that good news?
Well, the answer probably starts right here. You have to look at the runway leading up to this earnings report. The stock had been on an absolute tear, up over 25% in the last year. That's a full 10 points better than the rest of the industrial sector. Expectations, to put it mildly, were sky high.
So when you put it all together, the most likely explanation is just a classic case of buy the rumor, sell the news. The stock had this massive run-up, the news came out, and it was great. But maybe not blow the doors off great enough for a stock that was already priced for perfection. So some investors just decided to take their profits and cash in. All right, so that's the what and the why of the quarter. Now let's talk about what really matters. What's next for Standex? This is our take. This is the next call.
Here's how we see it playing out.
The market's one-day reaction, in our view, was focused on short-term noise, the profit-taking, the valuation. But the fundamentals, the actual business, are pointing to long-term strength. That record backlog is going to fuel revenue for quarters to come. So yeah, the stock price might chop around a bit in the near term as it digests these big gains. But once those cost savings from the restructuring start to hit the bottom line later this year, that provides a brand new catalyst to send the stock higher. The real story here is the strategic pivot, and for that reason, our rating is outperform.
And as always, a quick reminder, this analysis is for informational purposes only. It is not financial advice.